And what we focus on are pretty much the commodities that are driving the energy transition, and themes like electrification, storage and generation of renewables. I'm pleased to say that the companies put those building blocks in place, and we're now at the point where we're really starting to see the growth coming from that portfolio. We're trading at a significant discount to NAV at the moment, at about 0.4 times NAV, 0.5 times NAV. Then as we go into that growth in income, the dividend will naturally balance with that.
All right, today we're having a discussion with Geoff, the Head of Investor Relations of Ecora Resources. Geoff, thank you so much for taking the time. Perhaps we can start off with a short and sweet high-level overview of your business.
No problem. Thank you for taking the time to talk to us this morning. Ecora Resources is a mining royalty business. There are many mining royalty businesses out there, but most of them are focused on the precious metal space. So some people might be familiar with the names like Franco-Nevada, Wheaton Precious Metals, very large, very successful royalty businesses listed on the Toronto Stock Exchange. Ecora has basically taken a different track. We've decided to take that proven business model and deploy it to a different commodity basket. So we deliberately don't do precious metals to differentiate ourselves from that peer group. And what we focus on are pretty much the commodities that are driving the energy transition, and themes like electrification, storage and generation of renewables, the data centers and powering data centers, which is a slightly different take on it to the existing model. And there's much less competition in that space. Where Ecora sits today is at a quite interesting point in its evolution. We've historically, the business has been built off one large met coal royalty, which only has a couple of years of income left. So the challenge has been replacing that income. And that's why it's interesting as we sit here today, because we're on the verge of two things. One, a big increase in our income, which is forecast by our analysts to go from around $60 million at the end of 2024 to around $100 million by the end of the decade. But then within that, there's some further trends that are quite interesting, could drive a re-rating. As we transition from the income, that 60 million in 2024 will probably be about 40 million met coal. When we come to that number at the end of the decade, it'll be less than 5 million met coal. So we're going from about 60% of the revenue met coal to less than 5%, and the rest will be made up of base metals. So copper in particular will be a big driver for us going forward, and we're very pleased to have that copper exposure. And we think as that composition of the income changes, we should re-rate, because obviously short-term met coal income is not rated as well by the market as longer-term 20-year plus royalties in the commodity basket that we'll be exposed to.
Thank you so much for that overview. Really appreciate that. Perhaps we can talk about what requirements you have for actually acquiring a royalty or a stream. What are you looking for? What is kind of the return on investment Ecora is looking for before making that investment?
No, that's a very good question. We have two things I'd say. Firstly, we're looking across a different commodity baskets. So compared to the precious guys who focus just on gold or maybe silver, we're looking at everything from copper, lithium, nickel, cobalt, rare earths, uranium, vanadium. So we look across a much more broader commodity basket, and that gives us the ability to move laterally and invest at the right time in the commodity price cycle. So if we're looking, first of all, our base principles would be to first of all screen all the investments out there, or the mining projects out there in those commodity baskets, and then we screen them for 2 or 3 key things really, which as an investor with a 20-year time horizon is very important for us to have in mind. We're not like equity investors who can kind of dip in and dip out when something gets frothy. So from our perspective, we're looking very much for the quality of the ore body that has to drive everything. Then we're looking for mines that sit preferentially in the cost profile, the cost curve. So 86%, I think of it, of our investments are in the lower quartile of or the lower 2 quartiles of the cost curve. And that's really important because A, it means that they can weather fluctuations in commodity prices, and we only receive our royalty if that mine is generating income. So it's important they can stay on through cycle. So that cost curve positioning is really important, and it points to the quality of the mine. And then secondly, within that, we can choose when to invest. And so what we tend to look at is the last commodity price cycle for that commodity, and we can't pick the bottom, but we'll try and make sure we're entering towards the bottom quartile. And if we do that, then over 20 years, through multiple cycles, we think we should be exposing investors to upside risk on there. So those are the kind of starting points. Once you've narrowed it down, it's then really about relationships. Some of these investments can take us 5 or 6 years from the first time we've identified a project to actually executing, because the time needs to be right for the counterparty and it needs to be right for us.
Yeah, that's highly interesting, Geoff. Thank you so much for that overview. Perhaps we can also talk about how you pick the metals you're looking at for potentially a royalty investment. Of course, you talked about trying to time the bottom or the lower part of the cycle. But also, do you differentiate between certain metals are interesting to go into? For example, copper, you're talking about large-scale mines, potentially a huge ROI. Is that also a part of your factor?
Yeah, absolutely. We're looking at the long-term, what we think are the long-term drivers and supply-demand trends for those particular commodities. That's why we're very much bullish still on copper. And if we can price that at a long-term entry point, as I say, which we think can create a huge amount of value, then we're very interested. I'll give you a good example of like lithium is something we don't have in the portfolio today. We had lots of people saying to us 2 or 3 years ago when the lithium price is up towards 80,000, and clearly people who invest in lithium equities could see the value of those equities increasing and saying, why aren't you exposed to lithium? Well, for us to take a 20-year bet at a very frothy price was not a sensible thing to do. No. At that same point in 2022, we invested in some copper royalties at a long-term price assumption of $3.30. Now that was a very sensible bet in 2022 compared to that lithium. Now lithium's fallen, and this is the ability of working across a basket of commodities. So when the one price falls, we can switch and it becomes more attractive to look at for that entry point. So we'll be quite nimble in trying to move across those commodities, depending on which ones we think will be exposed to the long term, if you like, mega trends. And that's why copper will sit at the heart of everything we do, because we just see some things like nickel and cobalt, which we have exposure to, being very driven not solely, but partially by battery chemistry and battery demand. Whereas we don't want to be a pure EV play, we're broader than that, and a broader thematic. And copper just sits at the heart of so many of those things like the electrification and all those things I talked about a few moments ago. So we're very keen to keep copper at the kind of core of the portfolio, and we're still very bullish on long-term outlook for copper pricing.
Yeah, 100%. I mean, civilization couldn't exist without copper. We use it for everything, technology, wiring, electricity, everything. Perhaps we can also talk about your current portfolio, how it's looking at. Some of your royalties already in production. Some of them are at development stage. I think one is currently being commissioned into production. Perhaps we can talk about how that's looking. How are you expecting that to develop over the next few years?
Absolutely. I think we're slightly unusual for a royalty company of our size, and we have a diverse production base. A lot of our peers in size might have one producing asset, whereas we've got, I think, 9 producing royalties across multiple commodities. Now, I say we're at an interesting point in that development because for many years, the Kestrel metallurgical coal royalty in Australia has been the backbone of the business. And we've been effectively, in the last 10 years, building the replacement income for that, as we knew it would principally stop mining within our area at the end of 2026. I'm pleased to say that the companies put those building blocks in place, and we're now at the point where we're really starting to see the growth coming from that portfolio. So, I think I said at the start, this year, Kestrel will do about 40 million, and that non-Kestrel portfolio, the long-term business, the new business, if you like, will do about $20 million. As we look out to the next few years, that's going to ramp up towards 95, 100, if you believe the analyst assumptions around that. So there's multiple projects coming on there over the next few years and driving that. The one I think you mentioned, if you look at the production base today, the non-coal part of it is made up of uranium, vanadium, cobalt, and copper principally. If you look at the longer term drivers and those assets coming on in the next few years, cobalt, which is a stream, not a royalty, so we take physical delivery. The cobalt is ramping up now. It's a little bit later than we'd have hoped, but it's a great partner. Vale is the mine operator up in the Voisey's Bay mine in Canada. That underground expansion of that mine was completed in this quarter. So now we're seeing volumes really start to grow, and it will go from us receiving 4 shipments of cobalt in the first half of the year. We'll get over 10 in the second half of this year. We should get in the mid-20s next year, and then 40 in 2026 when it's at steady state. So we can see real growth in the next couple of years being driven by that. And we're at a cobalt price which is at a cyclical low as well, so we're quite levered on that one towards the cobalt price. Looking more broadly, then we have a couple of good quality copper developments, and it really switches to copper the focus then, with some copper, some nickel and some rare earths coming in the rest of that decade. So we really see us not just stopping at 2030, but a pipeline of growth well into the next decade, I say, and a lot of copper assets coming through behind that.
Amazing, highly interesting, that's for sure. You have that growth story baked into the price, replacing Kestrel, metallurgical coal with more diversified metals. Super interesting to see that. And you are actually paying a dividend currently. I believe trailing 12 months, we're seeing 7% on the share price right now. Perhaps you can talk about what your dividend policy is going into the future. Should we expect that number to remain roughly the same, or how should we model that?
Yeah, we changed our dividend policy at the start of the year, actually. We were paying a fixed dividend equivalent to about 8.5 cents per share, which is yielding about 12% And that was seen as unsustainable. And with this growth profile that I'm talking about, we could see a real, a lot of people we spoke to said, you're a growth company, you need to stop being an income stock. So we took the decision to actually change the dividend structure and formula and reallocate some more capital into growth. So what we did there was we put a formula in place where we'll pay 25 to 35% of free cash flow out in a dividend. And we do it on a 12-month kind of average just to smooth out the volatility that the Kestrel royalty causes at the moment, because we don't know whether that's going to be in or out of our lands in any given quarter. We know the amount of income or amount of coal that we generated through our land over the next couple of years. It's hard to predict on a quarter by quarter basis when that will be. So that's kind of smoothed it out a little bit. We paid, I think, 33% in the first half of the year, which equated to, I think, 1.7 cents per share. So I can't make any predictions for the second half of the year, but if you look at the analyst numbers, they'd expect something similar. And I think that would be the plan, to keep it sort of those sorts of levels for the next couple of years. Then as we go into that growth in income, the dividend will naturally balance with that. And that's enabled us to retain a sector-leading dividend for the royalty sector. And equally, it's enabled us to free up some capital for growth. So the money we saved by changing that dividend, for example, paid for our rare earths royalty that we acquired back in June, July this year.
Perfect, Geoff. Thank you for the great overview. Perhaps we can then also dive into your balance sheet, because we've talked about growth through your portfolio. Of course, as a royalty company, you can also grow by adding royalties or streams to your portfolio. Perhaps we can talk about what kind of cash you currently have on your balance sheet, and I believe you also have some debt. Can you take us through that overview?
Yeah, no problem. I mean, there's two principal ways. Just the first part, and I'll come to the balance sheet. We can acquire royalties. Clearly, there's the identifying a mining project which has a need for capital and writing that royalty with that mining operator. And I think you mentioned earlier, actually, I didn't answer it, the question about who the operators are and who we target. That's about targeting a good quality ore body, a good quality project, because then you can fund an expansion of that, whether it's a feasibility study or whatever it might be, and in return we get this royalty across the life of the mine, so you're not exposed to any of those operating costs or anything else. And quite often, if you pick the right projects at an early stage, they will then be picked up and owned later on by a larger company. So we do get asked, why do you have the Vales of this world on your and some of these large mining companies? Why do they need your capital? The other way we can acquire them is in the secondary market. So existing holders of royalties will sometimes look to sell them. When it comes to the balance sheet itself, we currently have a net debt position of $86 million. We have a facility that's 1.4 times leverage. We're quite comfortable with that as we sit here today. In an ideal world, royalty companies would be trading at a premium to their NAV, so issuing equity at 1.2, 1.3 times, and then buying something for 1 times NAV and creating a lot of value that way. We're trading at a significant discount to NAV at the moment, at about 0.4 times NAV, 0.5 times NAV, so we can't use our equity at the moment. So we're fortunate, and this differentiates us from some of our peers, in that we do have a balance sheet because of that diversified production line. So the debt facility today is the base facility is a revolving credit facility of $150 million, with some of the big Canadian banks, RBC, CIBC and Scotia. And we have a $75 million accordion for which you can use for acquisitions. Now, as a royalty company, we don't think we think investors are looking to a royalty company for a way of getting de-risked exposure to the mining sector. So they don't want to take a huge amount of balance sheet risk. So we've made very clear, and it's one of our sort of capital allocation principles, that once we will only sort of deploy that balance sheet if it's for an acquisition where we can see a clear path to deleveraging there afterwards. So that's really our philosophy. We don't look to keep running this business on a sort of over-levered basis.
Excellent. Thanks for that great overview. And perhaps we can also quickly outline, we've talked about the growth profile from about 60 million in cash flows today to about 100 million in cash flows by 2030. How much of that is already acquired in current royalties, and how much of that does need to be acquired in?
That's all in the business today, from projects that are permitted, that we have no more financial commitments to. So one of the beauties of the model is that once we made our initial investment, we don't have to put any further expansionary capital down. If there's an expansion of the mine or anything else driving life of mine extensions, we get that incorporated into that's the upside really to our initial base case investment. Life of mine extensions and commodity prices are the two things that would drive those outsized returns. So everything in our portfolio today we've paid for. There's no further capital commitments, which gives us the confidence in delevering. So if we're not making any further acquisitions, we would delever quite aggressively. And yeah, all those projects that I talk about there are permitted with good quality counterparties. So if you look at something like Capstone Copper's Santo Domingo project, which is a big one for us. That could generate $30 million a year to us, so it's probably the key one that's coming through the next few years. They've just built a mine 35 kilometres up the road called Monteverde. That's now fully ramped up. They're taking the team that's developed that and built that and using it to build the Santo Domingo mine. They just issued a feasibility study a couple of months ago, and they're now in the financing phase for that and looking to sort of move towards investment decision, hopefully towards the end of next year. So something like that is a good example of how tangible these are. They are not really, we have longer dated stuff we don't tend to talk about. These projects coming through in the next few years are real, are in the process of moving forwards and are all permitted. So yeah, it's that they're in hand in that sense, and no further capital deployment required.
All right. Well, great overview, Geoff. Thank you so much. I think we have given a great first overview of Ecora Resources thus far. So I would love to end off this short interview with perhaps what is the thing you are most excited about for Ecora Resources' near-term future?
I think just the growth that we have coming through in this portfolio. We're at a really interesting point now. A lot of hard work has gone in over the last 10 years to build this portfolio to the point where we have no further capital commitments and we have these assets. And it's really translating what we've built in net asset value and seeing that unleashed through income over the next few years, which should transform the business. So I think all of us in the business believe passionately in this business and can see where it's going without the kind of, and that's without layering on upside in commodity prices from where we are today. So we think we're in a really good position. And almost an inflection point of where the business has been for the last few years. So it's a really exciting time for Ecora, and we're all really looking forward to realising a lot of value, hopefully, over the next few years. Yeah,
that's great. And perhaps we can end this interview off with where can people find out more? Where can they perhaps get in touch with you to talk about Ecora Resources?
Yeah, people can find out more. We trade on the London Stock Exchange and the Toronto Stock Exchange under the ticker ECOR. We also trade on the OTCQX market in US under ECRAF. And look up on our website, www.ecora-resources.com, and you'll find lots of information there and directions to our sort of online social media accounts and everything else. So please do look us up.
All right, Geoff, thank you so much.
Thank you very much. Appreciate the time.